Let's have a look at special deductions and allowances. What are special deductions? Well, these would relate to where you are unable to get a deduction in terms of either the general deduction formula, or a deduction is prohibited or limited, or this is an additional deduction. These are provided for specifically within the Act, and they're in essence an additional category for possible deductions if Section 11A, the general deduction formula, is not available. If both 11A and the special deduction apply, we should take the special deduction as it takes preference. Each of these special deductions have their own requirements which must be met, and we are not allowed to double deduct, except in this instance of, let's say, Section 12H, where we get a deduction for the employee's employee costs, and then we get a special deduction in terms of Section 11H, learnership agreements. Here's a list of special deductions and allowances. Now, we're not going to go through every single one of these, but we will have a look at a few of these. Let's have a look at legal expenses. In terms of Section 11C, we are allowed to deduct legal expenses that are actually incurred on a claim, dispute, or action at law arising in the course of trading. So it's important to note the terminology. We say trading, it does not need to be incurred in the production of income. No deduction will be allowed where legal expenses are of a capital nature. So if we incur legal expenses to defend our capital asset, those legal expenses would follow the nature and then also be seen as capital in nature, and we would then not get a deduction in terms of Section 11C. However, we will get a deduction if the accompanying compensation or damages are either deductible under 11A or constitute income in the taxpayer's hands. In that case, we will be allowed to deduct the legal expenses that are linked to that compensation. If we have a look at an example, we have in the current year the following occurred. Yum Yum, a company that manufactures baby food. One of Yum Yum's customers, a 6-month-old baby, developed an allergic reaction to the organic butternut baby food, contrary to the results of previous research performed by Yum Yum. The baby had to be hospitalized on the 15th of July, and Yum Yum paid, in terms of a court settlement, the hospital bills amounting to $35,000, as well as the family's legal expenses for $5,000. We are required to discuss with reference to case law and legislation whether the $40,000 will be deductible in the hands of Yum Yum for tax purposes. Now, at this point, it's important to point out that when we are discussing this $40,000, we should split our discussion between what we're going to talk about in terms of the $35,000, the compensation that was paid, and then the $5,000 legal expenses. If we have a look at the solution, we can see we're discussing the compensation of the $35,000, and it will only be deductible if we meet the requirements of Section 11A read with Section 23G, which means it needs to be compensation that is the expenditure or loss actually incurred during the year of assessment in the production of income and not of a capital nature, and it must be laid out for purposes of a trade. So we don't really have a problem with most of the aspects except looking at whether or not this was in the production of income and whether or not it is capital in nature or not. So all those other requirements are met. To determine whether the compensation paid was in the production of income, we need to ask ourselves the two questions. What action gave rise to the expenditure, while the production and sale of baby food gave rise to the expenditure? Is this action closely connected with the income earning activities? Well, yes, it is. The sale of baby food is closely connected to the income earning activities. The case law from which these questions come from is the Joffe and the PE electric tramways. The compensation paid was therefore expenditure incurred in the production of income. Now determining whether it is capital in nature, one must establish whether it is part of the cost of performing the income earning operations, which it is in this case being related to products that are sold, or the cost of establishing, improving, or adding to the income earning structure, which it is not in this case. And the case law from which that comes is the new state areas. The compensation is not creating an enduring benefit, and it is a once-off expense. Therefore, it is not capital in nature. Since the compensation meets all the requirements of Section 11A, it will be deductible. Now, because the compensation is deductible, remember we almost have a tag-along clause with the Section 11C legal expenses. Therefore, the covering of the legal expenses will also not be capital in nature and will also then be deductible in terms of Section 11C. Now let's have a look at repairs, Section 11D. When it comes to repairs, we need to distinguish between a repair and an improvement. A repair will be a deductible expense, whereas an improvement will constitute a capital expenditure and therefore we will not get a deduction for it. However, we could qualify for an allowance. When it comes to repairs, we need to ask ourselves, was the original structure in need of repair? If the answer to that is yes, then we also need to consider, was it a restoration by renewal? So did we restore, let's say, the kitchen in a prospecting house? The replacement of subsidiary parts of the whole. And then identical materials do not need to be used in order for it to still qualify as a repair. So therefore, if I have carpets in a house or in an office that are in disrepair and they need to be repaired, if I replace those carpets with, let's say, laminate wood flooring, I'm not using identical materials, but I am restoring the structure to its original condition, where the floors are usable. In that case, you could say that those repairs, the replacement, even by using wooden flooring, is a repair. However, we need to make sure that it does not increase the income earning capacity of the asset, as that would then constitute an improvement. If we have a look at an example, we've got on 15 September, renovate. A 40-year-old female decided to buy a small house, renovate it, rent it out in order to earn additional income. The purchase price was 1.25 million. The property only required limited work before it could be leased. The first tenant moved in on the 1st of January, paying a monthly rental of 8,000 rand. After Reno had effected the following renovations. And we give you a list. So obviously what we want you to decide with this list is whether it qualifies as a repair or whether it is not a repair, therefore capital in nature, and then if there's an allowance that we could claim on that. We are required to discuss with reference to Section 11D, so they are limiting us to only look at whether or not this qualifies as a repair or not to go further and think about other allowances. In terms of Section 11D and case law, whether the renovation expenses incurred by Renovate will be deductible for income tax purposes during her current year of assessment, and you can assume that all amounts exclude VAT unless stated otherwise. Now, if we go back and have a look at the list, here we have the replacement of damaged carpets with wooden floors, installing a security system, painting of the exterior and interior walls of the house, landscaping the garden. The garden did not have a garden before, it was only grass. So a good gauge in terms of whether something is a repair or an improvement is often to just ask yourself the question is, did it exist before this happened? Well, the replacement of damaged carpets with wooden floors. Well, floors existed before. What was on the floor might be different. Therefore, that could be seen as either a repair or an improvement, but it would only qualify as an improvement if we could prove that it gets additional income earning capacity. With the installing of a security system, that means there was never a security system. We are now putting something new in. Is that a repair? Well, no, we are now upgrading, enhancing something, and therefore it would be seen as an improvement. The painting of the exterior and interior walls, well, that is just to bring the house back to its original condition. Therefore, that would be seen as a repair. Landscaping the garden. In the past, it was just grass. Now we've improved the garden. We actually have garden with plants and something that we have now brought in that wasn't there. Therefore, that landscaping would also then be seen as an improvement. It's important that when you discuss these questions is that you break it down into each individual item. So deal with the replacement of the carpets and wooden floors. Then go and discuss the installation of the security system. Then the painting, so that you will be able to score the marks for every single item because they should be dealt with on their own. Now if we have a look at the solution, it's important to note that the renovation costs will only be deductible in terms of section 11D. Remember we said all of these special deductions have their own requirements. It must be expenditure actually incurred, no problem, got that. During the year of assessment, no problem, got that. On repairs of property, occupied for purposes of trade or in respect of which income is receivable. So we are pretty much stuck on whether it is repairs of the property. It is occupied for a trade because remember she enhances it or she renovates it in order to rent it out to earn extra income. So we don't have a problem with those aspects. What we do need to have a look at is whether each cost can be classified as a repair. And a repair, remember, is the renewal of a subsidiary part, whilst an improvement increases our income earning capacity in terms of the Fleming case. The replacement of the damaged carpet, as we discussed, well, it will be seen as repair since it is the renewal of a subsidiary part. Even though we are replacing it with a non-identical item, we're replacing it with wooden floors, we are really just bringing it back to its current condition. We're not increasing the income earning capacity by this. The installing of a security system. This is not a renewal of a subsidiary part. It is a new addition and therefore it would be seen as an improvement and therefore there would be no deduction in terms of section 11D. Painting of the exterior wall of the house. This would be classified as a repair because we're restoring it to its original condition. Landscaping of the garden, similar to the installation of the security system. The garden is new. We will increase the income earning capacity. It is not a repair because we are not replacing a subsidiary part, but we are doing an improvement. Therefore, again, section 11D will not be allowable on this amount. As with anything, it's important to make sure that you go and you actually conclude. So we are concluding that the $25,000 for the floors and the $12,500 for the painting will be deductible under section 11D. However, the cost of the garden and the security system will be seen as an improvement and would be added to the base cost of the house. Moving on to the restraint of trade payments. Restraint of trade payments are actually seen as capital in nature. That's why we cannot get a deduction for them under section 11A. However, we get section 11C cap A, which allows us an allowance in terms of a restraint of trade, provided that this restraint of trade is included in the income of the other party, in terms of either paragraph CA or CB. The allowance is limited to the lesser of the amount divided by the number of years of the restraint or the amount divided by 3. So if we have a restraint of trade that lasts for 2 years, we will take the amount and we will divide it by 2, and then we will take the amount divided by 3 and we'll take the lesser of those, which will obviously be the amount divided by 3. It's important to note that section 23L prohibits a taxpayer from claiming a restraint of trade payment except as it is provided in section 11C cap A. Moving on to fund contributions by employers. any contributions that are made on or after 1 March 2016 by the employer for the benefit of the employees to any approved retirement funds. So contributions to benefit funds, medical funds are no longer deductible under Section 11L, but are deductible under Section 11A, read with 23G. So it's just important to note that Section 11L only deals with retirement funds. A contribution by an employer to the medical aid fund of an employee will be deductible under Section 11A. What's important to hear is that any contribution that the employer makes to these funds is deductible in the employer's taxable income. There is no limit on this amount anymore. In the past, many years ago, before 1 March 2016, there was a limitation. It no longer applies. Just remember that these contributions that the employers make on behalf of their employees is a fringe benefit. It's important to note that this does not include the amounts that are deducted from your payslip and paid over to the retirement fund. Those would not be contributions by the employer. They would not get a deduction for that because in essence it is a deduction from your salary. What we're talking about here is where it is a contribution by the employer. It is not being deducted from your salary. It would be included in your remuneration as part of a fringe benefit though. Next one, learnership agreements, which are quite heavily tested, so you should make sure that you are comfortable with learnership agreements as you can score some easy marks. This is the one instance where you actually get an additional deduction. So you'll remember you are prohibited from double deductions. Well, in this case with the learnership agreement, you are actually getting another deduction. You get to deduct the the person on the learnership salary costs, and then you get the Section 12H deduction over and above that. How does it work? Well, you get an annual allowance, which is annually for the period of agreement. If during the year it is for less than 12 months, you must apportion that annual allowance. A learnership, you also get a completion allowance, and therefore on successful completion of the learnership, where it is less than 24 months, you will get 40 or 20 depending on the NQF level, or 60 and 50, again depending on the NQF level, if the learner is disabled. If the learnership agreement is for more than 24 months, you will get the completion allowance as stated above for that year and each consecutive 12-month period of that contract. So if you think of, let's say, your normal articles contract, it usually is for 3 years and it would qualify as a learnership agreement. Therefore, the employers, in the year that you complete your learnership, you complete your articles, they would get we are in NQF level 7 and up, so they would get 20,000 times 3, because that is how many consecutive years you have done your articles for. So it's important to note that you get 2 separate deductions, an annual and a completion. So in the year that a learner completes their learnership, there will be an annual allowance or a portion of the annual allowance, and there will be a completion allowance. Just remember, if it's for more than 24 months, you will multiply that completion allowance by the number of that the learnership agreement is for. Another thing to note is that a learnership can also include an apprenticeship. The allowance amounts for annual and completion do appear in Section 12H, so make sure that you go to your legislation and highlight that for yourself so that you know where to find it should you not remember what the amounts are. Let's have a look at an example for learnership agreements. A learner, Shezi, who is in possession of an NQF Level 8 qualification, enters into a 24-month registered learnership agreement with his employer, Easy Employ Pty Limited, on the 1st of January. Shezi has no disability as defined. Calculate the Section 12H allowance available to Easy Employ if Shenzi successfully completes the learnership agreement on the 31st of December, 24 months later. You can assume that Easy Employ Limited has a December year end. So they start on the 1st of January. So in the first year, so month 1 to month 12, Easy, the employer, would be able to get a Section 12H allowance, being 20,000, remember, because it's an NQF level 8 and there's no disability. In year 2, they would be entitled to the 20,000 annual allowance. Remember, it's for the full 12 months, so we're not apportioning it. Had Shezi been disabled, it would have been 50,000. Then, because the learner completes their learnership in year 2, they would also get a completion allowance of that 20,000. But now remember, for each full 12-month period, so now because we're getting 24 months, we have 2 12-month periods. So if we're doing less than 24 months, we would only have gotten the 20,000 once. But because we are doing 24 months, or if it had been more, let's say 26 months for argument's sake, we would still have gotten the 20,000 times 2. And that would be the allowances that we get in year 2. Again, if they'd been disabled, we would be using the 50,000 times 2. We do not apportion the completion allowance. We only apportion the annual allowance. Let's have a look at qualifying donations, Section 18A. Remember, here we are looking at the deduction that we get in our taxable income. We're not looking at donations tax. Whereabouts does it come into effect in our framework? Well, it must be the very last deduction that we make when we are calculating taxable income. If you put it anywhere else, you will not get the marks. Okay, so it's vitally important that you remember to do it as your last deduction. Should there be an excess in terms of what we're allowed to claim for the year and what we actually donated as qualifying donations, we will carry that excess forward to the following year of assessment. The Section 18A deduction is only available for qualifying donations. So a qualifying donation would be a donation to a public benefit organization undertaking any activities as listed in Part 2 of the 9th schedule. In a question, we will refer to it as an approved public benefit organization. So if you see us tell you that it's a public benefit organization, then you would know that it is a qualifying donation. However, just because we made a qualifying donation doesn't necessarily mean we get a deduction for it. We have to obtain a Section 18A receipt. So in the question, we would either need to tell you that or say that we obtained all necessary documentation. Remember, the deduction is limited to 10% of taxable income before this deduction, and it excludes lump sums from retirement funds and severance benefits. The excess over and above that 10% will be allowed to carry forward to the following year. If a taxpayer has no taxable income or has an assessed loss, then no deduction can be claimed. It cannot create or increase an assessed loss. We would then carry the donation over, the qualifying donations over to the following year. Section 18A deductions are allowed for natural persons, trusts, CCs, and corporations. Let's have a look at an example. Lesego Pty Limited donated 250,000 to an approved PBO and obtained an 18A receipt during the prior year of assessment. They made no donations during the current year of assessment. Lesego had a taxable income of 1.85 million for the prior year and 2.95 million for the current year of assessment, before any Section 18A deductions were taken into account. We're required to calculate the Section 18A deduction available for both the prior year and the current year. Well, what did that look like? Well, we would have to look at the taxable income before Section 18A in the prior year. Of that 1.85 million, we are allowed to deduct up to 10% of that, which only gives us 185,000. Therefore, we have qualifying donations of 250,000. However, we only get a 185,000 deduction. The excess, the 65,000, is carried forward to the next year of assessment. In the next year of assessment, the current year of assessment, we now have taxable income of 2.95 million. Again, we are only allowed to deduct 10% of that. 10% of that is 295,000. We only have 65,000 of qualifying donations that were carried forward from the prior year. Therefore, we are limited to our actual donations of 65,000 in the current year.